In the model that I shared, there's at least 60, 70 parameters that you can change. Almost every single one of them is probabilistic, right? And when you model so many probabilistic things together and then say, here's my strategy, you start seeing what sort of portfolio risk reward model am I selling to my LPs.
Is it basically these two opposing forces? One tells you reduce the fund size to maximize potential returns, and then the other one says maximize fund size so you have more fees. Then you just have to arbitrarily pick a number and says, okay, this is the number that feels comfortable for me to run my firms and have fees, but also be comfortable with the potential returns.
The more you're exposed to meet great founders, you start building mental models of what is the right persona of a successful founder.
But based on that element of experience, that would mean that the 50-year-old and 60-year-old VCs would just outperform the younger one. Hello, Internet, and welcome to episode 8 of the ReallyCap podcast. My name is Kyane, and I'm a general partner at ReallyCap. Today's guest is Wael Nafee, who's a general partner at Raed Ventures. Raed Ventures is the leading Saudi early-stage VC firm, with around $450 million in assets under management, with early investments in companies such as Tabbi, Uniphonic, Foodix, Sari, Salla, Noon Academy, Lean Technologies, and so many more. For those who are not familiar with the region, these names might not ring a bell. But these are monster companies, many of whom raised $70 million rounds, and a few of them are preparing to IPO in the near future. While the Kingdom of Saudi Arabia is sometimes mistaken as an easy-to-fundraise destination, this misconception cannot be further from the truth. This conversation with Wael, whom many founders refer to as their favorite investor, offers a glimpse into the sophistication of institutional investors in the region. And without further ado, let's get into the conversation. Wael, thank you for doing this. Just to start quickly about your background, then how did you end up at Raed?
I've been at Raed for about 3 years now. Prior to that, I was an entrepreneur building things, and I spent about 15 years either founding companies that I've built, or more recently, and the most prominent part of my experience was being at Careem, which was a rocket ship. I was the VP of product at Careem for many years, and then later I was the head of a business unit at Careem, the platform super app business unit, which is what Careem is being positioned as today. It's a multi-service company super app. I joined fairly early. I was one of the relatively early employees. I joined in 2015, and I left about 1.5 years post the acquisition to Uber. So I've seen Careem grow from a relatively small size to a fairly large with the $3.1 billion acquisition. But prior to Careem, I've started many companies in various sectors. 2 of them failed, and one of them went through a smaller acquisition, which was good. But by education, I'm a computer engineer. I graduated from Waterloo in Canada, and I worked in the Valley for many years. My field was very deep techish. I was building software image processing algorithms on hardware chipsets, very deep tech. But then I moved from that hardware aspect to software and entrepreneurship, which moved me from being pure tech to really using tech to solve problems for users.
Do you think that hardware background reflects in your investment thinking now? And are you looking for that kind of hard to solve moonshot complex problems?
I don't shy away from it. I'm a techie at heart. I still write software in my free time just to help me think through things or model things. So whenever there's something that seems, this is getting into too deep technical, I actually engage with it, and I like engaging at a deeper level, especially if the deep tech that's involved is material in changing either the economics of a business or the user experience of a business, and really doing something material for the business. When people throw a lot of jargon at you, it's either to overwhelm you, just to say AI, Gen AI, and when you dig deeper, these things are not material to any fundamental change to the business, and that's when you know it's fluff. But when you get into the details and you try to understand it, you can quickly tell, okay, wow, this is something that can really change the game, and I don't shy from it.
For those who are new to the Middle Eastern landscape, is there real deep tech solutions being created in the Middle East?
Big part of these deep R&D things need to start off with government grants. Yeah. Saudi in general is pushing for a lot of government grants to push for commercialization of deep tech ideas, science that is coming out of R&D and PhD theses. And more recently, we're hearing a barrage of Gen AI companies. There are a lot of universities and accelerator programs that are focusing on AI startups. In Saudi Arabia, there is the Garage, where they're working with Antler. They're doing an AI startup bootcamp. I think they've got something like 80,000 applications, and they've picked somewhere between 10 and 20 companies. So there's a lot of people wanting to do something, and they're fostering that.
What about VCs? Do you think they're adapting to be able to have an open mind towards these solutions?
It's going to get there. They are going to need to have people on their team that are able to understand what is being said in a deeper way. Historically, VCs have come from finance backgrounds, and that's the norm. It starts off probably like that because the bigger focus is on disrupting business models. But then more and more VCs are pulling into their ranks operators. And some of the operators are people who've either built companies themselves or specialize in particular fields that help them do that. It's definitely happening in the region.
And that's how you fit into the picture. That's what I hear from founders, like oh, Wael gets what we're building. Oh, he's hands-on on the product, because you come from a product background. I think that completes the image. Going back to my initial question, what are your reflections as a professional investor who's been in the field for 3 years? You joined the industry in a very special time. What are your personal learnings out of this?
I joined when their industry was heading towards the highest of highs ever. 2020 and 2021 were absurd for private markets. It took me a while to get used to that, because when I was doing my startups in 2009, 10, and 11 in the Middle East, there wasn't a lot of money. I know many founders at that time, if anyone raised $50,000, it was just, wow, you've made it. And now there are people with pitch decks and ideas raising $10 million at $50 million valuations with just a pitch deck. But I think now with what's happening, it literally is coming from everyone in the ecosystem. Every investor say, show me your fundamental unit economics, show me your path to creating something that looks sustainable, but also big. And I think that's great. When money was very scarce and I was raising money for my startups and seeing the delta now, to me, whatever you raise is very precious. You better make every dollar that you raise give you the longest mileage for your business and the biggest impact for your users and the bottom line of your business.
I'm curious, and I'm asking not only because you, but each one of us, because we always ask ourselves, am I a good investor? I will only know in 10 years. What are the ways where we can reflect and say, hey, phase one, the past 2 years, these are the things that I grew on and worked on. And now phase two, I have to work on these things to continue becoming a better investor.
The key thing is, and this is now getting into not just on a per decision basis, I think a lot of times when people look at funds, they think that every decision on a fund is on an atomic level of should I invest in this company or not, which a big part of it is. But a part that needs to be there as well is understanding portfolio construction, looking at your whole portfolio and recognizing how is my investment strategy and how do I construct a fund that gives the right risk reward profile that I told my LPs that I should. It requires us to think a little bit more on a portfolio level thinking versus just on this startup. We're an early stage investor. A lot of times we invest in companies that don't necessarily have fundamentals yet. And the subjective piece of looking at a founder and saying, that's the founder that's going to learn, grow, have the humility to figure out when to step aside when they've outgrown what they're able to do and get someone better than them. All of these things are very subjective. It's so hard.
Based on a 30-minute Zoom call.
The initial impressions might be 30 minutes, but then we do a further deep dives for interested companies. And it's very hard. The analogy that I heard before, which I think is right, is you're looking at a 6-month-old baby and saying, this is going to be the president of the United States one day. It's very hard to tell. You rely a lot on pattern recognition and just recognize at the end of the day, you can't really fully know. And that's a subjective aspect that only comes with experience. You just meet enough people. I know from my experience, I look at the Careem founders, I know what DNA worked for them, but it's not the only template. The more you're exposed to meet great founders, you start building mental models of what is the right persona of a successful founder, the better exposure you get. And that's something I learned over time.
But based on that element of experience, if that was completely true and the main criteria, that would mean that the 50-year-old and 60-year-old VCs would just outperform the younger one. What are the other criteria that you think get into the calculation?
At every stage, your consumers become different and therefore it requires a different type of company to succeed. The VCs that have been out there for 40 years, sometimes they can get into a situation where their mental model of what a successful founder is doesn't change with the market and therefore they miss out on chances. This is something that you continuously have to be on the lookout for.
So it's a balance between amassing large amounts of experience, but also always stay ahead of the curve and adapting to the new realities.
Absolutely. It's a feedback loop that you have to incorporate into your mental model of, is this founder great or not?
Easier said than done.
Easier said than done, and it's extremely hard at early stage.
You mentioned the portfolio construction early on. You posted on LinkedIn last year an open sourced fund model for Raed you and your team worked on.
Yeah, we're in the process of, inshallah, announcing Fund 3 soon. And while we were thinking about Fund 3, there was a lot of introspection. What did we do with Fund 1? What did we do with Fund 2? How could we improve? What changes we want to make? And what are the things that we want to double down on? And again, because you mentioned that you only know if you're really ultimately successful 10 years down the line just because of the lifetime of a fund, it's hard to definitively say. So you try to inject a bit of quantitative, somewhat objective criteria mixed with your subjective take on the ecosystem. And what we were trying to do is, what is the right fund size for us? What is the right deployment strategy based on intrinsics that we see of the ecosystem, based on where we think the trajectory of the ecosystem is going? And all of these are just parameters. In the model that I shared, there's at least 60, 70 parameters that you can change. Almost every single one of them is probabilistic, right? And when you model so many probabilistic things together and then say, here's my strategy that you can also define, you start seeing what sort of portfolio risk reward model am I selling to my LPs? So you can see some sort of portfolio constructions are very high risk and high reward. And then you can say, that's what I'm doing. But just be aware. The most important thing is the awareness of the risk reward profile that you're selling to your LPs.
Well, I'm a very simple-minded person. So just correct me in this very basic reasoning, which is optimal font size for bigger returns. is just the smallest fund as possible. So just go with 10 million, go with 20. Hard to go wrong there. But then there's fees and you need to run a firm and you need to pay salaries. So let's increase our fund size so that we have more fees. But then is it basically these two opposing forces? One tells you reduce the fund size to maximize potential returns. And then the other one says maximize fund size so you have more fees. And then you just have to randomly or arbitrarily pick a number and says, okay, this is the number that feels comfortable for me to run my firms and have fees, but also I'll be comfortable with the potential returns. Is this reasoning correct, or can you poke holes into it?
You can definitely add more structure to it. I don't think you should pick randomly what you feel comfortable with and keep it in the subjective realm. I think number one, you have to think about what is your value proposition? What is your angle as a VC? Why do founders come to you? Your ticket needs to mean something more than just the value of the ticket, the dollar value of the ticket.
Mind if we get a real example? Your first question was, what's our added value and why founders want to work with us? From my perspective, when I speak to founders, they're like, oh, want to work with Raed because, okay, if they're speaking to you, they're like, the guy did stuff at Careem. He's a product guy. He knows what we're talking about. Second, there's the Saudi angle that can help us expand to Saudi, and almost every Egyptian founder wants to go to Saudi. Most of UAE-based companies want to go there. And also because when, at least from what they say, it's like when you look at the deal, you really look at the deal. Like you're going to go for weeks intensely and then take a decision and not just drag it for months. And then you have quite sizable ticket sizes and they know that you can put more money in the next round. For me, like these are the echoes of what people want to work with.
Yeah, there's a lot more behind that. A lot of it is, honestly speaking, humility, and we are speaking to founders on the same level. A lot of times people get the vibe, whether it's intentional or not, that some VCs, when they speak with them, it's, I have the money, you want something from me. And because the majority, all of the partners have been operators at one point, they understand what that means. And we're speaking to them on a level playing field. You're not begging us for money. It's really a privilege and an honor for you to allow us to invest in your company. And that leveling of the playing field, founders feel. They feel that from the very first conversation, they speak with us and it continues with the relationship forward, that we're really working hand in hand with them. The other thing is that we try to be as genuine and as human as possible. And I know it sounds very obvious, but in this business, people get carried away. But I think the other thing is, you mentioned about the Saudi angle. On the ground, we actually have a value add team that really works with helping you set up in Saudi and getting the right connections in Saudi. And, you know, we're always trying to grow that. A lot of founders are looking for, whenever they set up in Saudi, consumer behavior, market culture is very different. You need a local Saudi GM. We help a lot of times with hiring the right fit for you. There's a lot of these types of things that we actually have a team that works on that as well. So again, most founders of our companies that we invest in, the relationship that we have with them legally, legally, they are obliged to do normal reporting on certain things, but the amount of information that we end up getting is way more simply because that relationship exists.
On your point about access to Saudi, I think you're in a very unique position now, given how Egypt is evolving. And I was there earlier this year and almost every founder I spoke to was pitching expanding to Saudi by end of year. But you have a plateau or a buffet of Egyptian founders, many of them who are really good. And you basically have the option to choose who are the ones you want to partner with and bring it to Saudi. Is that description accurate? And do you feel it as a real responsibility? How does that play out? Because it's such a unique role that you play in a very important window of historic opportunity.
Yeah, so we don't invest in Egyptian companies only if they come to Saudi.
But they all want to. Do you sometimes tell them you should stay in Egypt?
So Egypt is in a unique position in the MENA region. There are a lot of business models that come out of Egypt that work well with the broader GCC as well. There are other business models that work well with Africa. And then the right answer is, don't try to get this into the GCC. The nature of the problems that you're solving, be it on an infrastructure level, is more fit for Africa. You should be thinking about expanding in Africa. And if it's a great founding team, absolutely would happy to invest in them as well. And we have examples of that. We have one of our portfolio companies, for example, they are expanding into Africa. They actually just launched in Tanzania. And that's an example where it doesn't necessarily have to be GCC and we've backed them. The other aspect to Egypt, which I'm hoping more of it happens, is Egypt has a lot of good tech talent. The universities there produce a decent caliber of tech talent, either on the engineering software side, PMs and others, that a lot of people in the MENA region hire from. And it's a low cost center in Egypt. And because of that, I really am excited to see more Egyptian founders do global SaaS plays.
The Tunisian way.
Yeah, this is the playbook of many countries. If you look at the economic uncertainty, the macroeconomic uncertainty in Egypt right now, instead of just building for the Egypt market, if you're uncertain if whether the economy will work there, why don't you build global SaaS companies? Yeah. And a similar situation happened if you look at Turkey going through the economic uncertainties. A lot of the founders and companies are building out from Turkey and targeting Europe first markets for SaaS and others. You see it in a lot of countries where the local population and the local economics and the dynamics of the market are not large enough or uncertain enough, and therefore that's what founders do. But combine that with the good tech talent of Egypt, they can absolutely do that.
You're literally describing the Tunisian playbook. just because of the small market size and population. We also got inspired by Estonia. I remember when I was part of the committee for the Startup Act, which is this set of rules, and we're pitching to the government to adopt it. One of the slides was the model, and this is what Estonia did, and this is why it worked. And we can do exactly the same thing. And here's why. Just this year, Instadeep got acquired for $600+ million BioNTech. And then Expensia also got acquired. And it's Tunisian entrepreneurs selling into Europe and having their back offices in Tunisia. Although I have to say, usually these founders have dual nationality. And it also helps to have one feet in Tunisia, one feet in either London or Paris.
In that case of the company that we invested in, there is one foot in Egypt and there's one foot in London.
I'm really curious about how you personally changed your mind on stuff. Which business models did you used to believe in and you were like bullish on, and that today you're like, you know what, this actually doesn't work?
This is a tough one. I have to be careful about what I say, right? But in general, B2B supply chain companies, there was a big boom in, I would say 2019 to 2021, there was a big boom there. And the thesis at that time that regardless of the model you take, asset light or holding inventory, it was seen that scale and tech can really disrupt that business. And I think it is probably true for certain sectors that we see that there is sufficient tech that can disrupt this business properly. So for example, we see that in the pharmaceutical space, definitely because the challenges there rely on providing the right software and the right infrastructure for that. But in other markets where it's pure FMCG, that's a lot tougher. And we were excited about that because we were excited by the possibility that really tech can change the game. And then now we're wondering, is that enough alone? And you see all of the players in this space from Africa to Middle East to India to Pakistan. Everyone's trying to diversify into other sectors. Like they're trying to add a fintech angle. They're trying to add this because they are finding it very hard to just rely on the fulfillment and reliability piece. And then the tech that's there is not adding as much value to your end consumer as possible. That's probably an example where that alone is not sufficient. What is a realization that came after seeing the challenges of the market. Very few are able to get that mix right because it's very tough.
That's fascinating. I had an earlier realization from one of these calls with FMCG founders. Don't you think that the informal market, the way it was created and structured, is actually the most efficient way of things working? That's why it is the way it is. It's because these markets are extremely segmented. They're cash heavy, they're trust-based. Those who work with the suppliers, they work with him not because necessarily the closest or the best, but because he knows him. So there's a lot of non-Excel sheet components where this is how these economies work. And the informal market for FMCG is optimized in the ways where if you come with your tech mind and say, we're going to aggregate, I'm going to push all the orders together and squeeze in the margins and have better visibility, that's just MBA type of thinking. But the street smart people will tell you it's just not how it works. Would you agree with that?
You have to be careful about this type of thinking, because if I look at my journey at Careem, the taxi industry being super manual and super informal, that existed and it was absolutely disrupted because in this case, there's a very clear experience shift with tech. Tech really ultimately shifted your experience in a way that people were initially willing to pay for it. Right now, maybe the Careems and Ubers of the world are challenging taxi level prices, but this on-demand nature of it shifted the experience.
And what about the other one? Were there business models where you were strictly against or extremely skeptical? You're like, this will never work. And today you're like, you know what? I was wrong.
Let me say this. Right now, Web3. Okay. I'm not against Web3. I just think that a lot of the startups that I'm seeing, I'll speak for the MENA region, are just features. Web3 is a feature of whatever it is that they're doing that is not fundamentally changing the game. I think Web3 chain, these are fundamental building blocks of technology that have the potential to change, but I haven't yet seen a full business model where this is a critical part of the experience and that they're solving it for the average user. I still think that this is a big thing for a niche group of people, at least for MENA. And I think people are building for a user that doesn't exist yet.
Since everyone talks about AI, I feel pressure that we have to talk about it. It's like a collective push on the topic. But since you mentioned it early on, and you mentioned like there's local initiatives and tech talent and accelerators, do you actually believe that each region needs its own kind of AI solutions? Or do you think at some point, some developed economies will be the exporters of that technology, and then most of the emerging markets will be net importers of that tech?
Yeah, so I think there are definitely going to be a few that will be big exporters of AI, but I think a lot of it can come from the region because a lot of Gen AI is LLM based. And I think we've seen this in the Arab world where a lot of people are seeing that Arabic first approaches where it's local to the language, to how people understand language. A lot of the stuff is very poorly implemented. If you look at the MENA region here, how many people use their phones in English because the Arabic versions of their phone, the simplest translations, the localization of an experience just absolutely is subpar. I've switched my phone to full Arabic mode for about 3 years now. And man, it's such a pain. And we're talking about the big companies like Google and Apple. And I don't mean to stick to just translations, but just localizations are tougher in general. Localization of business models, experiences, and as simple as even translations. So do I think that there are, when you're doing recommendation-based kind of things, generating kind of responses or things that aggregate understanding the user very well, I think there is definitely room for startups to come out of the region that really understands the MENA user or the Saudi user and the Egyptian user much better than the startups that are building it generically for the outside that works for US users or a European user.
I know you mentioned you're going to announce the fund soonish. How is fundraising in 2023?
Yeah, for us, alhamdulillah, it's going very well. We're seeing good responses of re-ups from our existing LPs. So I think for us, it's going well. But I will say that a lot of the institutionals, the fund of funds, where they do, this is their job to find and invest in the funds and the GPs that they want to back. The terms that they're putting now are a little bit more stringent, which makes a lot of sense. Yeah. In this world of abundance where money was very cheap, there's learnings for GPs on what they need to do differently, which everyone is internalizing, but also the LPs are doing the same. They're becoming a little bit more savvy on who they want to back and at what terms. So we're definitely seeing that.
Tell me if you're not comfortable to share, but I'm just curious, are they asking for veto rights, like opt-out rights, GP stake? Do they want to sit on the IC? What kind of asks do they usually have?
We haven't seen any of that. I think what we've seen more of terms that are negotiating certain economics, the 2 and 20, for example, is being challenged. Decommits are being challenged. People are asking questions there. They want to see, don't raise a fund too large, be more than you can handle. And their definition of how you can handle is your skin in the game. They're expecting more skin in the game. Why do you want to start like a $300 million fund in the region? They're auditing your thesis a lot more stringently. They're pushing back on your analysis. There's a lot more pushback on many different things, right? So that's the theme. The region here needs VCs. So I think some GPs will not make it, and as some startups will not make it as well. This is the norm of the industry. But I think the ones that do make it because they've shown a good track record, because they have a very thoughtful thesis, a thoughtful approach to the market, thoughtful way to capture value for LPs in the market, they will continue to exist. And I think they will be stronger if they're being forced by their LPs to be more disciplined.
Final question. On the same theme of personal development as an investor, if we had to meet again in 18 months or 2 years and we reflect again on your journey and my journey as an investor, how do you see yourself evolving as an investor in the next couple of years?
I would love to get a lot more in depth with different companies that are in businesses or sectors that I have not yet invested in, right? This is one thing I'd love to get a bit more. I'd love to see more and more IPO journeys. And when we're involved with a company that has gone from very early stage, we're an early stage investor, we normally come at seed, and then working closely with them until IPO, the more and more journeys of success means more and more learnings for us about how best to go through the IPO journeys, because we've seen IPO journeys that were not as successful. And honestly, those founders who are there have a lot more insight about what worked and what didn't and how to go about it. I'd love to get to learn more about that, to understand good, successful exits and how we can help companies do that. And I guess I'm always learning. I'm sure I have blind spots of things that I should be learning that I don't even know that I should be learning yet.
That's awesome. I appreciate you, man.
Absolutely. Cool. Thank you for having me.
Cheers.